Liquidity is all you need to be a profitable trader. And if you want to make 10K a month from trading, 100K a month from trading, whatever amount, all you need is to get the direction of the market right, wait for a liquidity sweep, and then enter on a simple entry path. That is all you need for financial freedom. It's what I did to quit my job. It's what my students do. This is the real deal. In this video, I'm going to show you what liquidity is and how you can use it to start making money today. Okay, so the first thing you need for liquidity is you need to use a higher time frame, right? So you've got to use either the 4-hour or the daily chart, because this gives us the direction of the market, right? The first thing we need to do before you get onto the charts, or as soon as you get on the charts, is you need to have a direction. You need to figure out where is price most likely to go. Is it likely to be bullish? Right? Is it likely to do something like this, enter on a retracement and take out some sort of high? Or is it likely to do this, right? Is it likely to be bearish like this? Or third of all, which not many people talk about, is it likely to just consolidate? Because if it's likely to consolidate, don't trade, right? That takes some discipline not to trade. But for the direction of the market, the only thing you need to use is liquidity, right? You don't need to use breaker blocks, order blocks, fair value gaps. You don't need any of that. You don't need volume profile. You just need good old liquidity. Now, liquidity, for those who don't know, it's essentially where would people put their stop loss orders, right? We're on the higher time frame, we're on gold, and this is a major market. It's probably one of the biggest markets in the world, right? Apart from like the S&P 500 and euro dollar, gold is probably one of the biggest markets in the world, right? There are billions and billions of dollars. There's huge institutions all looking at the 4-hour chart and the daily chart, and at this key high here, right? There are people shorting gold because they think it's at, at all-time highs, and then there are people who want to buy gold. Now, for those who are going to ask me, and I personally think we're going to hit 3,000 on gold. That's just what I think. But nevertheless, what we need to use for the buyers or for the direction of the market is we just need to look for where is the most obvious stop loss orders, right? Now, I hope it's pretty clear, right? It's pretty clear. We're in a bull market. Let me just zoom all the way out, actually. We're in a bull market on gold, right? You never ever short these things. It's pretty obvious that price wants to go to this high here, right? It wants to go to this high here because there's lots of people shorting. There's lots of people who use support and resistance, right? Who think that price is going to come up to this level and then bounce off like that, right? Now, if you've been trading for any amount of time, probably about more than 3 months, you'll know that is a complete load of BS, right? If price was to reverse, what it would actually do is it would do that, right? It would go up slightly. It would take out anyone who had their stop loss orders here, which is a liquidity sweep, and then it would reverse, right? And you probably had this all the time when, let's say, you're using support and resistance and you thought price was going to go down. It does, but it takes out your stop loss and then goes, right? Because these markets only move for stop loss orders, and they're highly, highly manipulated. And me and you as retail traders, we're not supposed to be profitable. This is not for us. This is for the big boys. So these markets are highly, highly manipulated, and they run purely based on liquidity. But we've got the direction of the market, right? We know where the higher time frame liquidity is. We know where the where the market actually wants to go. We're going to expect price to move up like that, and then we want to enter any sort of retracement on the lower time frames, right? We expect price to come up and then break through this level. So now that we've got the direction of the market, right, all we're going to do is we're going to get in the lower time frames and we're going to look for our entries. That right there is so important. I'm not on the 5-minute chart trying to predict where price is going to go. I'm on the 4-hour chart and daily chart looking for the higher time frame liquidity, the bigger picture. I've got my direction now, so I don't care what the 5-minute or 1-minute chart's doing. I'm only going to look for long. So very, very important that. Very, very important. You don't need to use lower time frames for your bias. Use the higher time frames for your direction, and then use the lower time frames for your entries. So let's get onto the 1-minute chart and see what entries we can find. Okay, so here we are on the 1-minute chart, and this is so important. This bit of price action right here, people, and by people I mean lots of retail traders, will be looking to short, right? Because they'll see some sort of bearish movement here, they'll see some sort of bearish market structure shift, or VWAP, or anything telling them to go short, and they'll be looking to sell in this mess right here on the 1-minute chart, without realizing the bigger picture, that we're bullish overall, and that more importantly, all the way up here is our key target, right? What price is actually doing is it's just moving down to take out stop loss orders. And I'm going to go up, and then here is a good probability entry, probably during London, and it moves up, and then gives you a retracement during New York, and it goes up. And if you are lucky, you do get a retracement during Asia, and then it smashes the objective. That right there is day trading summarized. So let's get the entry patterns, right? Because it's not enough to get the direction right. I had the direction in the market probably within a year in trading. I had it nailed down. I could always, 90% of the time I get a direction right, but I made no money because I didn't know where to put my stop loss, right? I had no idea where I was going to put my stop loss orders, and it always got hit. So what we're going to do is we're going to wait for something called a liquidity sweep. Now, it'd be easier for me to show you on this little blue, line chart, what liquidity sweep is. So we know we're bullish, and let's suppose you're bullish, right? Typically, you want to buy the dip, right? You want to buy any sort of retracement here, whether it's a fair value gap, order block, VWAP, any sort of indicator, anything telling you to buy. You want to buy the dip, right? You want to buy price when it's cheap. Now, what probably happens, and this probably happens to you all the time, is that price has come down, it takes out your stop loss right here, and it quickly moves straight to your take profit, or it gives you another entry and goes straight to your take profit, right? The reason it does that is because you didn't wait for something called a liquidity sweep or a stop run, right? That is what a liquidity sweep is. It's a fake move designed to take out your stop loss orders and, whoever else has their stop loss orders there, and then quickly and aggressively move off in the opposite direction. So that is what we wait for, because once you wait for a liquidity sweep, any entry after that is so high probability, it's insane. Okay, so here we are on gold on the 1 minute chart, and this is our liquidity sweep, right? We have almost, and let's make this a bit more clearer, we have almost relative equal lows here, right? Remember, we are bullish on the higher time frames. The only reason, let's just zoom out, the only reason this works, if we go all the way up here, is we know we're bullish on the higher time frames. If I didn't know I'm bullish, I wouldn't be trading, right? I wouldn't be trading and this wouldn't work. But because I know I'm bullish, and because I know this is a key time of day, for those who don't know, this is New York time that I'm operating in, right? So this is London session, right? This is an absolute key time of day. I know that this is a liquidity sweep, right? I know that this is a liquidity sweep here. This is just a fake move designed to take out stop loss orders, right? Price comes down, it takes out anyone who had their stop loss here or here, right? Take out anyone's stop loss orders here at a key time of day during London, goes up like that, leaves lots of fair value gaps, and gives us lots of room to enter here, here, or here, right? And we want to ride price up. That right there is the highest probability entry in trading, and you want to master that. You want to master that, because that took me like 3 more years onto my journey just to try and figure this out. So that right there, so important. Now, some people are probably going to ask, they're going to be like, oh, let's just zoom out a bit. I like this. They're going to be like, oh, Atif, what happened here, right? Was this not a liquidity sweep, right? Look at this. Was this not a liquidity sweep here? Did we not take out these lows here and then move off, right? Like, shouldn't have this happened? Well, this right here is so important, right? What we wait for after a liquidity sweep is a fair value gap, right? Now, a fair value gap is just a gap that we have here and here, right? We wait for a fair value gap. Right here, if we look very carefully, there is a little fair value gap here. There's a little fair value gap right here, right? So you might be thinking, oh, is this not a valid entry? This is so important, right? Get your notepad out. Put your phone aside. This is so important. When you are bullish, right? When you're bullish, you're only going to enter on fair value gaps in the lower 50%, right? The lower 50%. You're only going to enter on any fair value gap in the lower 50%. And when you're bearish, you're only going to sell any fair value gap in the upper 50%. Now, I'm not going to get too in depth on why that is. All you need to know is this is essentially a smart way of saying buy the dip, right? Buy cheap or buy low, sell high, right? Anything below 50% is cheap, and anything above 50% is high, right? Sell high, buy low, that sort of stuff. Now, I'm not going to, like I said, I'm not going to get too in depth on that. The reason why this doesn't work here is because there's no fair value gap in the bottom 50%, right? That is why that does not work there. So that right there, it's not a valid liquidity sweep, right? Very important that you understand that. And that's some advanced knowledge right there. That's some real advanced knowledge. But here, we look here, you get the Fibonacci, like this, like that. We can clearly see fair value gap here, fair value gap here. That's valid. And for some of you, you might be wondering, this is why I like the optimal trade entry, because by definition, I'm always going to be selling below the 50. I'm always going to be buying below the 50% or selling above the 50% level, right? 0.705 levels where I always enter. So that is why, for those who are wondering, that is why I use the optimal trade entry, because I think, or Fibonacci retracement, because I think it's probably the easiest entry pattern in all of trading. You don't have to worry about which fair value gap, where do you enter. It's all built into the model, right? You think it's very simple. You think the optimal trade entry is really simple. There's a lot more that goes on behind the scenes than you think. But anyway, here we are. So you want to enter on either this fair value gap or this fair value gap here, right? It doesn't really matter. You can enter here. You can enter on the lowest. Ideally, you'd enter on the lowest one. So you would enter on this fair value gap. Like that, right? Like this. Like that. And then you put your stop loss always at liquidity sweep low. I'm going to keep on saying this until everyone's profitable. And someone was in the comments was saying, hey, how come you always say the same stuff in every video? I'm saying the same stuff because it works, right? It works. This is what I use on a day-to-day basis. It's what made me profitable. It's what made all my students profitable. That's why I teach it, you know. If I was teaching you random stuff, you know, oh, liquidity one day, market structure this day, VWAP, volume profile, then, you know, I would have no idea what I'm talking about. And if you ever see someone who, you know, 1 week or 1 month he's talking about VWAP, next month he's talking about liquidity, then he's talking about market structure, that guy has no idea how to trade, and he's just selling you some sort of mental shit, or he makes a shit ton of money on ad revenue, right? So ignore anyone who's like that. I teach you the exact same thing because it's what I use on a day-to-day basis. And I know all about VWAP, right? I spent 2K on this guy's course, you know, G7FX, you probably know him. I know all about it, but I don't teach you any of it because you don't need it. All you need is a liquidity sweep, higher time frame direction, which you get from liquidity, and then a simple entry plan. So for me, I target a free risk reward ratio. As always, it doesn't really matter. Like I always say, don't target more than a free risk reward ratio. You really don't need it, especially if you can get this out on the 1 minute chart. I mean, I don't want to, no, don't try and sue me or anything, but you can get it almost every day, especially if you've got, let's say, gold and GBP, JPY. If you've got like two unrelated pairs, you can probably get set up every day on the 1 minute chart. So what you're going to do, set your limit orders up as usual, stop loss at this low, and let me just explain it again, because there's always going to be someone who can learn from this, right? Very, very unlikely. Remember, the whole reason price came down here was just to take out these stop loss orders. Very unlikely that price is going to come all the way down, take out your stop loss again, and then go to take profit. Very, very unlikely. Now, it can happen. It can happen. That's why we've got stop loss. But very, very unlikely, right? 9 times out of 10, you're going to be all right. I'm assuming you get a retracement, you should be all right. So what you're going to do is you're just going to let price do its thing, right? Set up the limit order. Get tagged in once. Get tagged in again. Bit more retracement. Let price do its thing. There you go. There's your take profit. So let's say you entered here, either 3:55 a.m. or even 4 or 5 a.m. New York time, and within 20 minutes you've hit take profit, right? If you're risking 1k like I do, you make 3k per 100k funded account. Pretty good life, boys. Pretty good life. And I've mastered this session in London because I used to I live in the UK. This is what I used to trade every single day. And for some people, they might be wondering, what if I miss this entry here? What if spread didn't get me in? Is this valid, right? Because it's after 4 a.m. and the silver bullet, or at least London session silver bullet, that most people will assume is between 3 a.m. till 4 a.m., right? That's like the golden time of London. What most people don't understand, and this is so important, for forex, the silver bullet, if you know what that is, if you don't know what it is, completely ignore what I'm saying, right? Just trade normal London session. But the silver bullet for forex is 3 a.m. till 5 a.m. Eastern. It's not 3 till 4 a.m. Eastern, right? Very, very important that. And if you don't believe me, go watch ICT's live Twitter stream, 6th of May 2023. Go about an hour into the video and you'll find everything you need to know about it right there. And that right there is some high level skill, right? That's some high level dedication that you won't hear anybody talk about, right? When I say I put tens of thousands of hours into this, and I spent 4 years studying and failing, that's what I'm talking about, bro. Like, I know what I'm talking about. I've gone through so much for trading, but you don't need to know that. All you need to know is if you do this at key time of day, you got your higher time frame direction, right? So you got your higher time frame liquidity on the 4-hour chart, all the daily chart, and then you get into lower time frames. You wait for a liquidity sweep, you enter on any sort of retracement on a fair value gap, target a free risk reward ratio. Forget the 1 minute chart. This could be the 5 minute chart, could be the 15 minute chart, even the hourly chart, even the 4-hour chart if you want to be a swing trader and you'd use the daily chart for your liquidity. This model works on every single time frame. I use this model on the 1 minute, the 5 minute, the 15 minutes. I never traded the 1-hour chart, and I use it on the 4-hour chart now as a swing trader. It works on all time frames. It's what I've used to make money. It's what I used to quit my job. Yeah, I love this model. This is, I think, after 4 years of trading, this is the simplest and easiest model in all of trading. Now, I do have a slight confession to make. Liquidity is not all you need. It's all you need for technical analysis, but you also need the right mindset. So go watch this full free 2-hour trading call. It should be on screen now. And right at the end of the video, right at the end of that course, you'll find everything you need to know about trading psychology, because I'll teach you how to actually rewire and reprogram your subconscious mind. And if you don't know what that is, you'll have a lot of fun. You'll have a lot of fun with that video. So go check that video out, and I'll see you in that video.